so much uh, the fear of going bankrupt, and my responsibility to people in my company. And we learned so much. This is my sixth cycle. There was a cycle in 73. There was a cycle in 79, cycle in 81, 82. There was a cycle in 86. There was another cycle in 08. And now this pandemic is number 6. So what the difference is, from standpoint of where you are and where I am, is experience. And nothing takes the place of being involved, putting yourself on the line to go grow the way you want to grow, and then have things happen that are outside of your control, that are totally things that you can't control, you can't do anything about, like high interest rates, or the collapse of the savings loan market that happened in 86, the collapse of the oil industry that happened in 86, the collapse of the banking system in Texas that happened in 86, 90 period. So what we learned through that period, and I'm going to take you to the bottom line. The bottom line is, in real estate, if you stay there as a career, and if you are an investor, there's liquidity, that you have to be able to have liquidity in a bad cycle. And what we found out in 86, 90, we thought we had enough liquidity, but we didn't, because it lasted too long. It lasted 6 years. The market declined very slowly, when these different industries collapsed that were part of the real estate industry. Savings loan was lending money, and the savings loan industry went bankrupt and disappeared. In 81, they were deregulated, and savings loans were able to put, rather than be restricted only to residential loans, savings and loans were able to go in and make commercial loans. Well, the laws weren't written properly, and borrowers who had no experience in developing could go get a loan, because it was like a drunken sailor. The savings and loans, were an owner of the savings loan put in 3% of the capital, the government put in 97%. And they got confused and thought it was their own money, and it wasn't. They didn't operate by the regulations. And what they did is something that actually caused them to go bankrupt. They would make a loan to you, and you have no experience, and they would say, you pay me 6 points for the loan up front. We're going to lend you that 6 points. So basically, you're putting up no money, and then they take that 6 points that they lent you back, that you're giving them back as earnings, and that caused the collapse of the savings loan industry. That issue right there. Okay, and then what happened was the oil industry, collapsed. Oil went from $30 a barrel to $15 a barrel, and as a result of the oil industry and the savings loan industry going bankrupt, loans started to default, get defaulted at the banks. And so basically, with oil and real estate, that were 2 strikes against the bank, and the banks went bankrupt, and in Texas basically, and had to be totally recapitalized at the end of 89. So it was a different period, and most people in this pandemic, real estate it's got really good sponsorship. In other words, the banks have learned not to lend, heavily lever. There's 35% of equity put up into every deal now. So that gives the bank a lot of security on their loans, that they're going to be, they're not going to go into default. And real estate's just well sponsored today. So this period is, we've been in this a year, we're coming out of it now, and we've created this miracle of being able in a short period of time to create the vaccines that we have that will cure, the viruses. And the statistics is going up, a higher and higher percent of cure with just about every one of them. So what we learned was you have to have liquidity, and you don't know how long a cycle is going to be. So, you've got to build it. At the same time, you're being entrepreneurial. You're spending capital. It's about financial engineering everything in real estate. So the other is to not get over levered, where your loan, if you're there with the first lien and you're able to put a second lien, you might be up to 80% or 85% of debt, and that's really too high. It's taking too much risk, and if something happens in the market, it can cause you problems that your loan is going to go into a deficit, and you're not going to have enough income to pay the loan. You're going to be reaching into your pocket, and eventually you might become illiquid. So liquidity is one issue. Low leverage is the other issue that we learned, and the other one is stabilized income in a company. In other words, if you have no cash coming in and you have to make it only on commissions, and the market goes, south, like what happened, in retail, or what happened with hotels, because industry shut down, people were operating remote, nobody was traveling, and so the hotels started to have occupied 6 to 10%. Well, normally a hotel needs to operate at about 55 or 60% to break even. So those three things are really, really important. Even today, as you start in your career, those are three things that you need to be aware of. And the difference is between 86, 90 and the pandemic and where we are today is that people are more liquid. The companies have more stabilized income, and the assets are lower levered. So it might have taken 2 cycles or 3 cycles or 4 cycles to understand how you have to underpin your company for stability to make it through, because in real estate, you're playing a long-term game with short-term cycles. You never know when the cycle is going to hit. So that's how we'll stop there. And if you have any questions about that now or later, we can take it however you want to handle it, Alejandro.
Yeah, great. No, thank you. That was a very in-depth answer. I definitely want to move on. We have like 10 questions. And JB Garza actually raised his hand first, so I'll let him go ahead and ask his question.
Thank you. Can everyone hear me? Okay. Well, my question is kind of an offshoot of what happened in the 80s. So I'm a broker that works for developers, and I thought it was kind of amazing the way that financing was set up back then, where essentially the developers were printing money because they were getting 100% financing for the projects. But in the chapter, you mentioned that some of the strip malls and some of these other areas were poorly built, and so they were never really leased up because money was freely around. And I was wondering, in the repurposement department, what have you kind of seen for those poorly built strip malls or places around Dallas being made into something else now post-pandemic?
Okay, well, those buildings that were poorly purposed were in many instances done by people that were inexperienced. They laid out the properties wrong. They put the buildings too far back from the street. Just because it was a piece of property to be developed, they thought they could just put a building on it anywhere. Or they didn't pay attention to the accessibility to the property. It didn't have a curb cut in front of it where cars could easily get into it. Or one of the other things that happened was that, coverage is a very important part of real estate development in retail, and it is in other categories as well. Just because if you have brick and mortar on the property and you lease it, you're producing income. Well, you can if you're covered at 25%, you're going to produce a lot more income than you are if you're covered at 15%. So, and coverage is the building to the land. In other words, if you've got a tract of land that is 100,000 feet and you put a building that's 25,000 feet on it, you've got 25% coverage, and that's a good ratio in retail. For every square foot you have in the building, you have 3 square feet out in the parking. So that's a good ratio because you're producing like the maximum income that you can produce. Well, in a lot of instances, because savings and loans were putting out money indiscriminately to people that didn't understand, they thought, okay, I'm going to get the coverage up. I'm going to go put 2 stories on the property. Well, that was a mistake because the second floors don't rent like the first floors for retail. And what they did is they did that just to get the coverage on the property. And a lot of those 2-story developments went bankrupt and were taken back by the savings loans. Primarily, those were savings and loans during this period. Commercial banks and life companies since that period haven't done any of those. Like there's one down here at Maple at Inwood. It's gone through several cycles, just got remodeled. It's 2-story. And second floor is still they got a lot of vacant space. There's another one that was built out there at LBJ. It's Gilman. It's area's a very bad area. The center is just absolutely probably 10% or 15% occupied, and it's always been a very poorly occupied property, and so it's just been written down, and it's one of those catastrophes that happened during this period. But after the saves and loans went away, the banks came back in with life companies. There's a lot more discipline that has been ingrained in the capital markets. And today, I'd say it's really, with all the changes that the banks have done and the new laws that have been put on the books, right today, I was really shocked during this cycle that there's not more foreclosures. It's in better hands. And so that's just a learning process. So from your standpoint, I think you got to get it with people, and when you get out, and hopefully you're there in a company that's entrepreneurial as compared to a corporate company, because in a corporate company, you got a job and you're getting a paycheck, but the question is where are you going to go? How are you going to grow? And my position is, I think that being in this state and being in Dallas, Texas, or Houston, or San Antonio, or Austin, where we're going to have this unbelievable growth, I've never seen a better opportunity for growth for someone who thinks entrepreneurially, who wants to get exposed to ownership and development, and in that you learn everything. You have to know capital markets, you have to know construction, you have to know leasing, you have to know management, all those things. But you will learn that, just like I thought I needed to go to law school to be in real estate, and I went over to SMU and talked to a couple of professors. You're going to learn all the real estate, all the law you need to know if you're a broker, because you're going to be dealing with leases and sell contracts, and you're going to end up with negotiating every paragraph and every line, and you're going to understand it. Well, that was true. In fact, I ended up so I drew my own contracts because I got to know it. So
I got a quick response. I actually own my own brokerage, so a smaller brokerage, but I primarily work with developers. So I've kind of learned on the fly with dealing with different developments, but I'm also doing a development program in A&M in the fall. It's called Master of Land and Property Development. And so my plan is to switch from brokering to developing, or at least be a general partner on some projects starting late summer or in the fall.
Okay.
Most of the stuff I'm working on right now is distressed asset sales. So I've got a couple large portfolios, mainly in the hotel space, that probably will close in the summer, and then I can move on to developing.
Okay. All right. Well, let me just, there's a fork in the road, and which road you're going to take, because when you, I was with the last 2 or 3 days, went out of town with one of the great lawyers here in Dallas who got out of law and went into development. Okay. He's 63 years old. He got in development 5 years ago. And the other side of it is that he's there in a company and he's doing a piece of the development work. Okay. The key is in development, do you want to be there doing a piece of the development work, or do you want to be the one who has the ability to find the deal? See, that's what you got to ask yourself the question, because in one hand, you're going to be a member of the team. The other side, you're going to be the leader of the team.
Yeah, I think there's going to be a lot of different options.
You see what I'm saying? Because you don't have any development work unless there's a deal. The one who finds the deals are the most important people. It's like if you could be a hitter in baseball, it doesn't make any difference, you know, how fast you run, or it doesn't make any difference how good a fielder you are. If you can hit, they're going to find a place for you in right field or left field or center field. You're going to be on the team. So I'm talking about, do you want to be that hitter, or do you want to be the one that's in the cog and somebody else is creating the deal and you're on a team to put it together? Where I think if you find the deal yourself and you ask enough questions, and you're in an environment that's entrepreneurial, you're going to find the answers yourself to how to develop that property.
I can find deals, and I'd say there's a very high probability that I'd someday soon come to you with a deal or two to review. So
perfect. That's good. So that's a question that we could talk about later. But let's go to the next question. We got a bunch of them.
Thank you for your time.
So the next question is asked by Amwan.
Can you guys hear me?
Yeah.
All right. So towards the end of the chapters, you mentioned how you wanted to take Weitzman public through a real estate investment trust, but that didn't work out due to various reasons. So now that circumstances have changed, do you ever see that as a possibility, or do you still see taking the company public as a bad idea?
Okay. I don't see the company being public. And what happened is in 1984, actually in 1979, a company that was on the West Coast, Grubb & Ellis company, very strong company in California and Nevada. They were American Stock Exchange company at that time. They approached us to merge. And I was at that time president of commercial operations for Henry Miller Company here in Dallas. That's where I started in 61. And this now is almost, 23 years later. And we've grown from 5 people to 1,700. And Grubb & Ellis on the West Coast was 1,900. That year, their 1,900 had made out of their entire company $1 million pre-tax. And Henry Miller, and this was an unbelievable year. It was a record year. It was a waterfall year because it's so costly to run a brokerage company, and you never make much money because you're always expanding. But we had made $10 million pre-tax. And no, not that year. That was when they came back to us in 84. But in 79, when they came to us, their philosophies of operation as a corporation were different than the Miller Company, which was entrepreneurial. And, we were, in Texas and things were happening. So 5 years later in 84, they came back to us and they said, our thinking's changing. We've made 1 million, you've made 10 million, and we'd like to merge. And we thought, okay, on the philosophical approach that this company, Grobanellis, is gonna merge with us. They'll own us. We made a deal at 5 times the pre-tax. We got $50 million. Henry Miller Company got $50 million in stock, basically, which some was restricted and some wasn't. And then we would go buy other companies, and these other companies would keep their culture with the head of their people, because this was pure brokerage, and that we would grow through a family of companies, and these companies would keep their name in Atlanta, in Florida, in Ohio, in New York, and in Pennsylvania, and all that. So we merged 5 years later because they changed their philosophy, and one of those philosophies was that they didn't allow their people in 79 to develop or invest in real estate. They wanted the brokers to only do brokerage, and you couldn't go and do a deal or put together a transaction. And that was the deal stopper, because we had already, we were highly entrepreneurial, and we were bringing in all kinds of great partners who helped the Miller Company to grow. But in 84, they came back and said, we're changing our thinking, and we're going to grow the way you've grown. So we decided to merge. And in 3 years or 2 years, the honeymoon was over. And this company had gone on the New York Stock Exchange. I was a board member when we merged. So I experienced being on the board. I experienced having dinner. It's very heady in the boardroom at the New York Stock Exchange, and so I saw the fact that they never talked at a board meeting about the customer. All they talked about was the stock price, and that was not our philosophy. That wasn't our culture. If you take care of the customer, you take care of yourself. And what happened is I went off the board in 89. I was there 5 years, and I didn't like the public the corporate culture, and went back to I set my own company up at that time, because they wanted to do some things corporately that they wanted to centralize everything to San Francisco, and you can't go change an entrepreneurial company to operate with some of the restrictions they want to put on the companies that we had bought. And so fast forward to right now, is that absolutely not. What I see in the corporate real estate companies, some of them, the ones that have continued international companies, they're based on corporate accounts, basically. They do everything corporately. It's a good business if you want to be there for salary. You can manage a building, you can do all kinds of things for corporations, you can run their properties for them, and on and on. But you're very, very restricted. So that's just not us. You got to decide what you want. And the corporations, in most instances, what we found is you're just a number. And if you rise to the top, you'll make a lot of get make your company successful. You'll end up getting a nice salary, maybe bonuses. But it's totally different than the mindset of owning real estate and being able to have that as future security for your family, the income, pay it off, and or grow your own company, because today with technology, pretty easy, there's so many services that you could buy and operate with just a laptop. You miss if you're by yourself, you miss a lot of the creativity, and you're out of the mainstream. So by operating by yourself, but I would our company today, if we would have we were going to go public in 94, because I thought that was going to be where we would have a steady stream of capital. And fortunately, we missed the market. The dividend rate that we were going to pay, we were told by Goldman Sachs, who was going to take us public, we were going to out at 8, and the market cap was 225 million for the 92 properties we were putting into the offering. And we missed the market, and they said, well, we can get you out at 9.5, and that was about a $75 million hit to that public value. And we stay private, and most of these guys who have the public REITs today, their ownership is 3 to 5% or less, as compared to us controlling our future and having ownership of our company and having the flexibility to develop real estate entrepreneurially, where if you're in a REIT, you cannot compete with the shareholders. Does that? So I wouldn't be there. It depends on what you want, and it's a good training ground if you get to see multiple parts of the real estate program. But then eventually it could be a stepping stone for you to go on your own if you're in a public company.
Yeah, that makes a lot of sense. Thank you.
Mm-hmm.
Great. So the next question is from Lorenzo.
This might be my banker calling me. I was going to tell him checks in the mail. Yeah, so go ahead. I'm sorry.
No, you're all good.
That was a joke. That was a joke, guys.
My question was, so there's similarities, I feel like, between the start of the pandemic with a lot of support from the government for business owners and just general, I guess, loosening of certain regulations for a bunch of businesses to either open up or sustain themselves with loans and similar things. And it kind of struck me as pretty similar with the S&L companies. Mm-hmm. So I was wondering, do you see any similarities, at least in the business world? Because I've seen it a lot for some local businesses that we have in Flower Mound, at least. But I was wondering what you've sort of seen on a larger scale in terms of any kind of bad loan decisions or any kind of bad structuring that's coming up because of all these possibly more inexperienced people coming into it.
Let me make sure I understand your question. Is that are you asking about the comparison of any changes that have been caused by the pandemic in terms of government restrictions as it relates to, like, okay, the government closed up all retail as compared, is that where you're going with that? Let me make sure.
That is what I was trying to ask there. Yeah.
Well, we had to adapt very quickly because when this first started in March of last year, we saw a tsunami coming, where retail was really right there, going to get hit. And when you have a problem in retail, the worst thing can happen is tenants can't pay their rent, and that means you have problems paying your mortgage. And so we projected that, on different models, 30%, 40%, 50% collection. Well, this is where that low leverage that I mentioned earlier came into play. If we were 75% levered, we would have hemorrhage losses. But our company is 43% average leverage. So what happens is that you can end up with less than half your income and still pay your mortgage. That's where you get in trouble, is illiquidity. If you're paying to keep your name good, even though it might be a non-recourse loan, and you're able to pay it because you're low levered, that's great. Because when if you give back properties and you make new loans, you have to sign an affidavit. Have you ever given back a property? Have you ever had property foreclosed on you? Well, when that goes to a lender and you've made submittal for a mortgage, they see that and they might turn your loan down. So what you don't want that on your record, even though so many people have it. And everybody went through it, but it still is not good to have on your record. It's like having bad credit. And gas and borrowing is the gasoline that runs our engines in development. So the changes that we had to make were a philosophical one, that we'd see who had problems, because we have over 3,500 tenants in our management operation. And we had about 1,300 requests. And we put together a task force of about 10 people that for about a year now, from morning to night, they have been dealing with the tenants to help them with deferments, and not abatements. Abatement is forgiveness of rent. We would let some tenants abate rent if we got an extended lease from them. But the ones that needed deferment because they don't have deep pockets, and we know that store is supporting a family, and with the jobless rising, and job disappearing, we didn't want to put anybody in harm's way at the worst time of them going to try to find a job. So what we did is we abated rent, and in some instances we would forgive rent, but in some instances we just told people, look, you don't worry, because it caused a tremendous amount of anxiety, and we didn't want people to give us the keys back. We said, look, we'll work with you. How could they do business if the stores were closed? How could they do business if people weren't going to come in the store because they were afraid to, because they might get the virus? And so we were able to work through this, and our people did a fantastic job. We brought back 99% of our tenants. We only had very few close. And what's surprising is the repayment plan started back in November. So here we are, November, December, January, February, and now March, and we've had remarkable collections on the money that they owed us back, that are paying us back, and some of these people pay us back through 21, through this entire year. It's been a very difficult period, particularly in retail and hotels. Office is now getting hit because corporations are finding out, and so many people are operating remote. So how many people are ultimately going to be full-time remote? Probably 20%, where it probably was next to nothing before. So we don't need that much office space, and tenants leases are expiring, and some people aren't renewing. So there's more, we have a vacancy factor here that is one of the highest now in the country. It's about 80, we're about 82 to 83% occupied. Now, the amount of surplus sublease property, there's a lot of tenants that have closed up, but are trying to sublease, they're still paying. So we're having to build back, and that's what we're doing right now as everything improves. But fortunately, it's going to happen faster than most other states because we have so much in-migration. Companies coming here and people. Okay.
Awesome. Thank you.
Great. The next question is from Joseph Salmaran.
Okay, yeah. So I really like chapter 5, just because you showed a lot of the ups and downs throughout your career and stuff. So, and I found that you showed a lot of tenacity and willingness to be successful. I just wanted to admire that a bit because I think that's something that we can all learn from. But my question is surrounding around mixed use development. So I live in a smaller town close to Oklahoma, and there's still a lot of growth here. And there's like some entertainment spots or like new restaurants coming up, but they're scattered all throughout town. So my question is for a smaller town, outside of like Collin County or Dallas County, how feasible do you see like a one-stop shop property that's mixed use that has restaurants, entertainment, maybe offices also, compared to like a grocer type anchor situation where it's just one anchor and maybe a couple other operations?
Okay. Look at the Galleria here. The Galleria is in the center of North Dallas, and that's mixed use. And we leased it. Gerald Hines built it out of Houston, and we were the leasing agents. And that project is in pretty much of a depressed condition today. You go in there, you'll see a tremendous amount of vacancies because what's happened with the mall industry. Near SMU, there's Mockingbird Station. That project has really never been successful as a retailer, as a retail center. Too much competition around it. I think that one thing that you have to have with a mixed-use project, you've got to have density, and you don't have that in a small town. So you got to have where people come because you've either got in the project a hotel, or you've got office, or you've got apartments, or you've got retails. Four components that make up a mixed-use project. Well, if the center is a failure, you could lose money 4 ways at once. Just think of that. You could lose it in the hotel, you could lose it in the apartment, you could lose it in the multifamily, you could lose it in the retail. And I just don't think that I've done 2. One is in Austin, it's called the Triangle. We made no money. It's right there at Lamar and Guadalupe. It's very inner city, and it's very difficult and it's very risky. We did another out here in Plano on the toll road at Parker. We have office, and we have apartments, and we have retail there where Eatsy's is, right there at Parker and the toll road. And the one thing that is a big problem in retail is when you build a mall or you build some of these mixed-use projects, or the lifestyle centers that came in, some of them have failed, is that retail gets turned inward. And one thing about retail is it's very important to have exposure. So when you get back to exposure, where's the best exposure? It's in the neighborhood strips, which is where you all should be starting. That's the small property that is the less risk. It's up front on the street. You got the exposure, and that is the safest. And it's also financially manageable. It takes the smallest amount of capital. So, but the other is community center, which maybe has a grocery store. See, so I think that it's very difficult to finance mixed use today. So and particularly if you're going into a small town and you're asking a question about that, I would think absolutely not. Don't spend a minute's time on it. Deal with your open strips, your community centers or your neighborhood center, and they will be successful.
Right. Okay, gotcha. Yeah, I was just wondering about that because on paper it seems like a mixed-use development always would seem ideal, but now that you mention it, it seems very risky.
Well, the thing about it is that it's going to cost you pretty much the same cost to go build a center like that in Anna, Texas, up here off North Central Expressway, as it's going to take to build one here on at Campbell Road at Central Expressway.
Oh, okay, gotcha.
It might be just a little higher land cost there at Campbell Road, but the land cost is going to be pretty high up there now.
Right, right. So, and then in that case, it's all about, like you mentioned, density.
Yep.
Okay, gotcha. Well, thank you.
A very risky thing. I stay away from it. You might, you might go in and do that later after you're very successful in the real estate business and you have liquidity and you have assets to back you up, but because it's high risk and it takes a lot more capital.
Right. Okay.
Mhm. Next one.
Sweet. So the next question is from Jonathan Chang.
All right, hey, good morning, I should say. Um, so I had a question concerning the period where there was a little bit of inflation, or rather, let me rephrase. The Fed has they've noted that they will be targeting inflation at moderately above 2% for the next couple of years.
Mm-hmm.
And so I follow another real estate investor in Arizona, and he was mentioning that debt will be more of an asset and cash will be more of a liability in the coming years. And that got me thinking because in your book you mentioned that you were burned very badly by being highly leveraged. And so I want to know your stance on your company right now. Are you guys looking to expand aggressively, or are you trying to stay with your roots and with your learned experience, stay at a low leverage point?
Well, let me correct one thing. Is I wasn't over leveraged in going into 8690, and I had a lot of capital. The thing is it was so deep because it lasted so long, and the three major industries went bankrupt, including the banks, that you didn't have enough capital. Nobody did. Trammell Crow, who's Dallas based, was at that time the largest developer in the United States, and they became illiquid. Lincoln Property Company, one of the largest apartment companies in the country at that time, became illiquid. Vantage Company was Travelers as a partner, that ended up going away during that period. It was 5.5 years, almost 6 years. Nobody is set up to do that today. Now, here's the thing about, right, we're going to have a lot of inflation. We're having it now. You just don't see it. Lumber prices, its commodity has gone up substantially. But it's crazy. Steel, last 2 months have gone up 35%. Again, a commodity. It's going to come down, but people are wondering what to do with their money. This is speculation that's driving that. Cost of housing in Salina has gone up from 280,000 to 390,000 average in the paper. Just looked at an article before we got started here. See, so yes, one of the best places is to put money into real estate. It doesn't make a difference. Look at what's going on in the housing market. Buy a house, buy a rent house. Start off with a rent house, and get used to paying a mortgage and getting rent and handling it and managing it and so forth. So, but real estate is one of the best hedges against inflation. And we actually have annual forecast, and Peter Lindemann, who's top real estate economist out of Harvard, teaches at Harvard, did a fireside chat with me, and he echoed that. He says one of the best places is to put money in real estate as a hedge against inflation. Real estate rises, the cost of land is going up, the cost of building cost of buildings is going up. So the rents are going up. Yeah, you need to be invested. So get down to your question. Are we higher lever? Have no higher lever than we were, but we're in a much better position from a liquidity standpoint. We're in a much better position from stabilized income standpoint. To have. Let me turn this off. Yeah. So those are things that you change. But I'll tell you what, I don't know any other way to advise you to get into real estate other than that to minimize your risk would be to be with somebody who is your senior, maybe a generation ahead of you or a generation and a half ahead of you, that's really walked the hot coals, that has made it through, that has capital, that has real estate, that has stabilized income, that is still playing between the 45-yard lines, that's active. And to be so important to that person or that company that you become a partner. And you sometimes start off small, or being able to work with the company and they have an opportunity for you to put small amounts of money into a transaction that's being created in the company. Get yourself around the right environment. It's going to make a big difference in your career. From mentoring, big time, opportunity, big time. And your goal is to help that company grow. And you're going to be recognized if you do that.
That's fantastic. Thank you.
Okay.
Okay, it's going to be our last question because we're going to end at 12 today. It's going to be from Sina.
Hi, Mr. Weitzman. I actually have two questions, but
Sure.
I'm trying to keep them short. So first, going back to chapter 4 and the downturn, and you said some remedies are, financial engineering, low leverage, and then not solely relying on commissions, so having a stabilized income. So would you say that any real estate brokerage has to branch out to some extent to have that stabilized income and not rely on commissions? Or what would be a way to implement that advice?
Absolutely. I think that that's the way you incentivize people with you and give them this wonderful path for growth. I think it's also it's very important to have that in a company, because companies that without it today, just look at the exposure that they have. One real estate company totally closed up here, a company that was in business a long time, had 15 brokers, and they decided, well, we don't want to lose all of our assets, or a few that they had, by the losses that they're going to face going forward. They shut the whole company down. See, so that's very important to a company to have stabilized income. Now, I'm not saying it's an ironclad guarantee. You might have if you have bad asset and you end up with a prolonged real estate depression, it could be a double it could be double jeopardy, because you end up having to taking your cash maybe to pay and cover loans as well as cover overhead.
Right.
But the key is that you've got to be low levered. See, if you're low enough levered, then you will not have to put money in to these properties, even if you lose tenants, unless you're making new leases. And this is what we do. We don't want a domino effect that the further you go in real estate with vacancies in a bad market, the harder it is to come out when things get better. Just because the property looks depressed psychologically because it has too many vacancies, and it takes so if you're way down here, then leases typically in a cycle, let's just say the average rent is $20 a foot, and then it gets bad. It goes, you're making deals at 18 a foot, then you're making deals at 16 a foot, and then you get down here. Let's just say it gets down. If you don't make deals, you're down here and you've lost tenants, and people are making deals at 13 a foot. So look at all the losses and the risks that you now have been created by you not being an active player to keep making deals and keeping the center full. and riding the rent. When you start down here, you're at the lowest point,
Right.
and it's going to be the biggest losses. So you have to understand that even though it's bad, you have to stay with it, and then to build it back because the markets do rebound.
Well, thank you. I think that's a great answer to my question. And hopefully the second one is really interesting to everybody. I was wondering if you have an opinion on Compass going public. They just went public, I think, a few days ago, if not yesterday.
Company?
Compass?
Compact.
Yes, it's that real estate. Well, they call themselves a tech company, but they're basically, I think they have like 20,000 brokers all over the US, and that's kind of their business model, just brokerage. I don't know if you've heard about it or not.
Well, I think that's more in residential.
Yes.
You're not able to pick that up in the commercial sector. And you know, when we were in the residential business with Miller, and we had about 1,500 agents, and about 200 were commercial. And I've never wanted to have a residential component of my company, because what happens is you got to have just this unbelievably special person who can build it, and there's very few people like that around. And then the other thing about that is that so many of the agents are part-time. You know, and so many of the agents are female. They have a family responsibility, and they do very well part-time. But it's not. We have to, in commercial, you've got total responsibility every day. If you're representing a tenant, or we're leasing a shopping center, or we take on sale assignments, or we dispose of a portfolio of commercial buildings for some company, and you've got to be right. You got to be on your best. You know, you got to be in your best game every day, and we can't have people that work part-time. And so with an operation like that, it's a residential operation, and I just don't know too much about it. Sorry.
Yeah. I was thinking basically along the exact same lines. I was wondering, despite the fact that they have about like over 19,000 real estate agents, you don't know, like you as a stock investor, you don't know anything about the quality of those agents. So I was a little skeptical, to be honest.
Exactly. Yeah. Now, what we have done in the brokerage business, there was a company that got farmed out of the West Coast called Chain Links, and it's interesting. Chain Links were members of this group. These were independent companies that were member of this organization nationally for referral of business. And they had a provision. It goes back to when we were going to merge with Grubb and Ellis, and they didn't like development. Well, the Chain Links said, we're restricted from developing. Well, that whole network system in the United States is almost disbanded, because these companies grew up just like you're going to grow up. You're going to grow up, and you're going to end up in real estate one way or the other, and you're going to end up in ownership one way or the other. These same people that were brokers were being restricted commercial from owning any real estate, and so they left. Now, the ones that I co-founded, called Retail Brokers Network, with a very good New York street firm. In other words, they did all of street leasing in all New York City and Manhattan, and so we now are very, very big, and we're in 62 metropolitan areas of the United States. It's not a director-run company. It's the CEOs of the companies make up the board and operate this. And at the Retail Broker Network, I've had a big influence in helping some of these companies move just out of brokerage, because every one of them wants to own real estate. They just didn't know how to do it. And so I've helped guys now. It's made me, I just have great satisfaction that they call me up and say, oh, I just bought another building, and I mean, one guy in Denver, he owns 4 buildings now. And he comes down to Dallas, and he stayed at my house, and I mentored him and told him how to do it, and he's doing it. It's wonderful. See, so I think that That's the difference in a philosophy. This retail broker network is flourishing, where this other program with chain links is really not, because it's been restrictive, and too many people get exposed and to ownership. Well, why not? Why not take the risk when you buy a better car or you take better vacations? You end up later and wearing better clothes and having a having a better house and sending your kids to better schools and on and on and on. I mean, everybody wants that. So that's the path that I wanna encourage with everybody who's thinking about real estate, commercial real estate.
Well, thank you very much. I think that was a super informative session again, as always.
Thank you. Okay, well,
Yeah.
so nice to be with y'all, and y'all stay well. Looks like we're on the 12 o'clock right now. I got to go into another meeting, so thank you guys, and we'll look forward to the next time. I don't know, somebody will set it up and let me know, and we'll get through these other chapters. But I'll tell you, these chapters I was looking over last night. I'm telling you, reread that. I mean, that is just, it was just tough. It was and in your life, you're not gonna, sometimes you just can't see these things because they're external, and everything. We think that we want to control everything, and these are things you can't control. We can't control, but you sure have to be prepared for life throws different things at us, particularly when you're investing. But one thing about real estate is that, and if you're on the entrepreneurial side, you can do a lot of things you can control. You can go do things and make things happen, because I'm looking here, I'm on the 6th floor and I'm looking out and I know real estate broker or somebody in real estate made everything happen as far as I can see. And that means you can control a lot, just like I have been able to do that. Not that it's a straight path, it's a winding curve, and that's the way you just grow, and you think more strategically all the time, because you're going to know more about every phase of the business as you grow in the business. So, okay, well, look, good to be with you. Thank you so much for letting me share some thoughts with you guys today, and we'll look forward to seeing you next time.
Thank you.
Okay.
Thank
care. Bye. Thanks. Bye-bye.
So guys, just before the meeting ends, I'm gonna put in the chat one more time well, you can just look up anybody can sit in that. But thanks so much for everybody that came out today. I really appreciate it.